Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. It's the middle of August. The streets of the city are quiet, but the news flow keeps on coming. We kick off today, therefore, with interim figures from estate agent and real estate advisor Savills. Hugh Moorhead is here to discuss the outlook for the global and UK property markets and a little bit about the company itself too. After that, we look at our big read of the week, all about some of the parts valuations. James Norrington looks at companies breaking up and bolting on and asks how investors should think about shares and their overall value in this context. To wrap up, we will turn to the big weight loss drug purveyors Novo Nordisk and Eli Lilly, who have been in a battle of the blunderers this summer. Julian Hofmann is here to talk about what's next for each of them and whether they can maintain their market leadership in the face of these setbacks that we've seen in recent weeks. To begin with, we are looking at property, though. Savills, today as we record, is Thursday the 14th of August, which is the day Savills has put out its interim figures. Hugh, let's have sort of a top-down overview, first of all, of the data they've put out. Seem to me the figures more or less in line, but there's, as is often the case with Savills, a lot that needs to be done in the second half of the year.
Yeah, exactly. So it's been an okay first half there. Decent performance for revenues, which were up 6%, just over $1 billion, and also for underlying PBT, which was up 10% to 23 million. As you say, those are generally in line with analyst expectations. What that does mean, though, is that Savills have got a lot of work to do in the second half of the year to hit market expectations for full year PBT, which is about 150 million. So the mentally, arithmetically agile of you will have worked out that that's about 85% of PBT, which comes through in the second half of the year. So there's a big weighting to that second half. Management seem generally unconcerned about that and expect a strong pickup in transactions from about September onwards.
Let's maybe take a step back and talk about the divisional breakdown of Savills, because everyone knows it as the estate agent because that's the consumer-facing side, but it has tried to gradually move away from transactional activity over the last few years. It does have a few other divisions, albeit transactions are still a big part of it. What share of the business is accounted for by each of these divisions nowadays, and how did they do this time on a broad level?
Savills' business is now separated about 1/3, 2/3 between transactional revenues, which are what they sound, and what it calls less transactional revenues, which are in areas like consultancy, property management, and asset management. If we go through those individually, the transactional business was not great in the first half. It accounts for about 1/3 of revenues, so it's still pretty important. What was the biggest headwind here? It was probably the uncertainty that followed Liberation Day in April. So we had companies postponing many of their key real estate related decisions in the wake of Liberation Day because of the macroeconomic uncertainty associated with it. And the Savills has been pretty quick to highlight a real slowdown in pace, not just in North America, but also in UK, wider Europe, and Asia Pacific as well. In terms of that big, broader, less transactional bucket, so first of all, there's consultancy revenues, which are about 20% of group revenues. As ever with the term consultancy, it encompasses a broad swathe of services. These include things like planning and development, project management, and valuation. That business actually performed pretty well in the first half. Revenues were up 20%. Part of that is because of a bit of an accounting rejig, but still about half of that is because of strong organic growth. So that's pleasing to see. The property management business, which is about 40% of group revenues, did okay. There was a little growth there was a little bit softer. And then finally, the investment management business saw revenues fall, but profits increase. So partly because of some downward revaluations in the portfolio that it's managing.
Well, let's talk about the UK, which is still a large chunk of certainly the transaction business and some of the others too, as you might expect. Start with the commercial markets. What's the latest information we've got from Savills on this front? There's some promising signs there.
Yeah, exactly. So it's worth noting that Savills is still very much a UK-focused business. The UK is 40% of revenue and 80% of profit. So Despite its international presence, it's still really important for it. And as you say, Dan, the UK commercial market, there's been a bit of a mixed performance. Investment volumes are pretty subdued still. Again, probably a legacy of Liberation Day. But in certain areas, we are seeing strength. And as you say, prime office is one of those in particular. We're seeing good take up across the capital for prime offices. So Savills is well placed to benefit there. It also commented that its property and facilities management businesses in the UK are also doing well. Outside of London, business is a little bit more subdued.
Yeah, it's that story we've seen, haven't we, about the lack of good quality prime office space in London means there is still decent demand there, and clearly companies getting people back into the office. Those stories that continue to play out as the year goes on, is something which Savills has said in the past, as one might imagine, is good for its business and is good for the prime London market too. The residential side of things, somewhat different though, almost the opposite in some ways. Central London has really been struggling in these figures.
Yeah, exactly. So Savills' residential business is very much more weighted to the prime end of the market than most estate agents. So it's probably not fair to read across from its results to other peers. But yeah, as you say, the prime London market has been really soft. Resales in particular have been down. Tax changes in last year's budget mean that your purchases of prime London property now come with fairly punitive stamp duty rates. So if you're looking to install yourself in a Mayfair townhouse, for example, it now makes a lot more financial sense to rent one rather than buy one. Other areas, though, have been okay. So, for example, development sales are still okay, and also the revenues that Savills generates from its small portfolios of student housing have also been pretty good.
I will at this point just complain about Savills no longer breaking out to the UK business, because it's now a part of EMEA, isn't it? They do provide a lot of this info we've just gone through, but it's quite annoying because we all like to talk about the UK property market, and we're going to keep doing that for a minute because let's talk about residential. If we think about some of the recent activity we've seen this month, obviously there's been an interest rate cut, base rate cut by the Bank of England, albeit there may not be many more in this cycle. Just today, we've had some good GDP figures out. Mortgage rates, to go back to the conversation about rates, are falling too. All that said, Savills, a prime property agent, the market has been fairly moribund, lack of transactions for a long time now, as we all know. What do we think about the outlook for the UK market for the rest of this year? I mean, that's not where Savills is pinning all of its second half weighted profit expectations, but do we expect much change? I know you wrote about this separately this week, Hugh, about some of the potential drivers, one of them being rate cuts, are potentially fading away as well, or not very likely to occur.
Yes. So again, as you say, less related to Savills' prime property business, but the outlook is probably slowing a little bit in terms of positive news for the UK property market. So although, as you say, the Bank of England did cut last week, it was the accompanying commentary was more hawkish than we've seen recently in recent meetings. I think they're forecasting inflation to peak at 4% now in September, so that's double their 2% target. And some economists are only forecasting one further 25 basis point cut, which will be unwelcome news to the entire property industry. So what that means in terms of mortgage pricing is that we're possibly unlikely to see much further improvement. So prices are unlikely to come down dramatically. We may see a bit of improvement because of other factors like the loosening of bank lending regulations and other government attempts to stimulate a bit more pricing competition among lenders. But that's probably not going to touch the sides too much. And then in terms of stimulus, there's a government inquiry into housing affordability open at the moment. That will take its time. And whether that actually results in some very concrete stimulus, like a Help to Buy program being reinstated, for example, remains to be seen. Analysts are kind of varied on where or when that might happen. But no one's expecting that in this autumn's budget, I think it's fair to say.
Yeah, with the focus very much on saving money and boosting revenues, it seems that either Help to Buy or a return of a stamp duty holiday, for example, are unlikely at this stage, albeit governments always seem to get there in the end, as the end of their terms near and elections arrive. So that might be something for later down the line. Let's move away from the UK and look at some of the other regions briefly. Is there anything else to sort of pick out here in terms of performance trends and things we've gleaned from these figures at the half-year stage?
Yeah, so the US, which is another important market for Savills and is almost entirely transactional, has been a bit weaker, unsurprisingly, because of those delayed commitments in Q2 that we've spoken about already. The Chinese commercial property market is still very weak as well. Savills don't do too much resi there, happily for them, so they're not exposed to that particular slowdown. Hong Kong, on the other hand, has still been pretty strong, and Savills also seeing good growth in India, although that remains a relatively small part of their revenue mix.
I want to talk about the dividend next, because it has a bit of a yield, and it might be one reason why Savills is relatively popular with a few UK equity investment trusts. And it says it pays this dividend from its non-transactional revenues, the part of the business that's been growing, but there has been a bit of a spotty history in terms of dividend growth. I guess they would certainly say, and the investors' hope would be that as that side of the business grows, the dividend growth might become more consistent too.
Yeah, exactly. So as you say, their dividend policy is a bit more complex than most companies because of that split between transactional and less transactional revenues. Savills aims to pay a progressive dividend out of its less transactional revenues every year. So that's the interim dividend that we've seen today. That was up, I think, 4%. So to about 7 pence, so not too bad. And then the transactional dividend is much more variable and is paid out or is announced along with final year results, depending on how strong the transactional side of the business has been. And that's why we tend to see those year-on-year fluctuations. So as a shareholder, you perhaps have to do a bit more work to model your dividend yield than you would do for some other companies. And perhaps for this reason, some of Savills' US peers like CBRE and JLL don't tend to pay out dividends if they're going to distribute. They tend to go via buybacks instead.
Well, we should wrap up by looking at the potential for capital growth as well as dividends. We have had Savills on a sell. Shares are down 20%, a bit more over the last year, another 5% today, but partly for valuation reasons. And, well, I think you're about to tell us maybe more why, but we are no longer maintaining that sell position.
Yes, so when we put Savills on a sell last year, it was on about 16 times earnings. It's now much lower than that. It's on about 10 times its 2026 earnings. Given that analysts expect EPS to grow at about 15% in each of the next few years, that means that price earnings growth metric, which can be quite useful in these circumstances, is now below 1, and so screens is considerably more attractive. If as Savills hope, the property market globally is improving as well, then they should also benefit from that. I don't think it's a sell now, but I think the outlook is definitely more constructive for them. But I think to be buyers of the shares, you have to have more conviction in the rebounding market than we perhaps do.
Yeah, that makes sense. Remains to be seen as ever. But we will keep an eye on the property market and on Savills too. Now, though, we're going to turn to our big read of the week, which is all about something we talk about a lot in various contexts, that some of the parts valuations, a way to value a company's shares, the inherent value of a company's business. James, can you tell us a little bit about the thinking behind this particular piece and the way you've approached this topic for this feature?
There's a couple of angles to it, really. I mean, if you think about, looking for cheap shares in a typical Ben Graham fashion, sort of godfather of value investing, always looked for a margin of safety with versus sort of the market capitalization of companies versus the sort of the value of their assets. And so one of the things is actually to look at how different divisions of a company are valued, what's their true productive potential, and what sort of margin of safety does that give you in terms of buying the shares. A second point really is different companies have different segments that perform well. I mean, sometimes you might want to buy one business that's part of a conglomerate and the rest of it isn't that good, and you want to sort of so it's partly about thinking about what are you buying when you're buying into a company over one the story of one division. And partly it's about, is ultimately as a shareholder, it's your capital that you're putting in, and is management, are they investing that capital in the areas of the business that are growing the right way? And if they aren't, is there a good reason for actually, is it because of diversifying business and cyclical risk, or is there some sort of long-term strategic plan? So it's always good to think about the divisions of a company that you're investing in, and how those parts move and how they're valued.
Over recent years, it's fair to say, if I can sum up the entire investing landscape in a sentence like this, that the conglomerates you mentioned, broadly speaking, the trend has been towards breakups or hive-offs or spinning off divisions. Activists certainly have been more successful in pushing for these kind of moves. There are, of course, arguments, as you say, about diversification and international strength for keeping things together, but that seems to have been the way things have gone in recent years. What does that maybe tell us about current investor priorities and thinking?
Well, I think in recent years, some of it's to do with slightly higher interest rates in recent years. So sort of with this coming down now, but capital is scarce, which means that people want to know that it's been invested in the right way in the most productive areas of a business, but also so is time. So some companies are just better off focusing on what they do well, and those tend to be the activities that generate high operating margins, and where the payback suits investors' time horizon. I think obviously that's probably where the activist element comes in. Some want to make money quickly for a big bang disposal, and sometimes it's a business where investors are sort of investing, expecting a dividend over the longer term. But we've seen some a few strategic decisions in recent years. BP is talking about selling Castrol Oils. Now that's a profitable, good business, but they're realigning strategy again, and that's to do with reducing debt and having a more resilient capital structure. So that there's a reason to sometimes dispose of a good business. Ditto sort of National Grid, which obviously in the energy transition, it's such a huge sort of capital undertaking, and yet they still have to balance that with the expectation that shareholders have of that company is it's going to pay them a dividend. And they reset their dividend policy a couple of years ago, but they still need to do things which help them manage things like their interest coverage and their cash position, which is possibly some of the thinking behind disposing of the LNG terminal to Centrica, which was announced today, which I think Alex Hain will be covering in more detail for the magazine as well. And then sometimes it's just companies want to focus and streamline and focus on the best, most profitable part of their business, which is sort of WH Smith is the example that I've looked at in the feature, where they're really now selling their high street business to private equity and really focusing in on travel.
So let's talk about Smiths a bit more, maybe, because you mentioned operating margin, and clearly that's one obvious way to see which is the most profitable part of a business or the most profitable parts. But what are some other ways investors can get a sense of where management's focus is or where it should be in terms of how investors look at the company balance sheets, company income statements, things like that?
But so starting with what you said with operating margins, what you want to look at is operating margins alongside the percentage of capital expenditure to the sales of a division. And realistically, you should have where your operating margins are higher, the percentage of capex to sales for those divisions should be higher. It shows to show that you're putting your money in the areas that are generating the highest return, and that's a good sign that the company's going to get a higher return on invested capital over the long term, which is obviously what compounds away and ultimately adds shareholder value. On top of that, some companies they report assets by division. Smiths did pre the pandemic, so it was a good one to look up to before 2019. It was easy to see that the percent of capital spent on a division compared to the percentage of assets accounted for under that division. That's another sign of where management is seeing its priorities. I think Smiths did that well prior to the pandemic. Obviously, they was hit very hard by that, but travel was clearly, no pun intended, the direction of travel was travel before then. And these are very sort of useful metrics to see that the focus is where you feel it ought to be, and it's particularly useful for businesses like that, where you'd think in terms of sort of cyclical dynamics. The diversification isn't really so much there by having sort of a high street and a travel business for, the economy goes down and retail sales and those that they're probably going to go down in both. So you want to be on a leaner, more profitable business focus. So I think it's the right call for them.
Yeah. Some cases it's more complicated, or many cases, of course, particularly in the case of international arms and international exposure. And perhaps an obvious example here of a business wrestling with that at the moment is HSBC, which you've written about before and you touch on in the piece as well.
Yeah, I mean, with banks, you're really looking at how their return on equity compares to their cost of equity. And that can be different across divisions. It's interesting, actually, in the recent results, it was actually the China exposure that had sort of that dragged on HSBC little, but overall, the trend is a far more profitable business. Even from a sort of regulatory capital perspective, it looks stronger on the Asian side of the business, albeit there's probably a few more question marks about how sort of the risk weighted assets are calculated in Asia vis-a-vis areas like Europe. But if you were to look at the sort of the valuation of HSB as a whole, and you'd think, well, it's probably a bit cheap relative to its overall cost of equity. The return of equity, is pretty decent, and it could be valued more highly. But there's obviously a bit of a risk premium in there for potentially for if it were to break it. There has been activist moves from I think Ping An Insurance, Chinese business, notably in the last couple of years, that probably reflects the fact that if it were to be broken up, then there isn't is the question marks over the business in sort of the Western Hemisphere can carry it and drive it on to those heights.
HSBC was one of the deep dives we've introduced over recent months, and you do touch on some of the other companies we've focused on in that section in the piece, in the context of some of the parts valuations. And just on that front, it occurs to me as well, of course, we should also say that when doing these calculations, of course, when you think about huge businesses, the centralized costs are always something to watch for too, just as an aside here. But it's not always the case of being able to just take out a division and extract that value, because sometimes there are centralized costs, but also centralized synergies too. But can we talk about maybe some of the other companies we've focused on in the deep dives? And
well, I think I mean the most recent one, which obviously you're probably better place to talk about than I am. But that's something like Openreach, which has obviously been sort of seen as a big sort of growth business for BT. It's interesting because I mean this is the risk with any division is similar to a whole company is there's an enormous variation in terms of what analysts and consensus or analysts, or rather there isn't enough consensus over where they think the growth could be. That does make it hard if we go back to the start of this conversation where we're talking about that sort of margin of safety for a business. If you're banking so much on growth in one area of a business, and that's often that can be a bit of a recurring theme, that companies will often they'll talk up one area. That they're hoping to. I mean, I think the other deep dive we did recently, WPP. It's sort of similar. That there's a lot of hope for sort of. I mean, I think that this seems to be a theme now. Anyone chucks in the words AI, it seems to be covering and certainly covering for some deficiency somewhere.
If you're in an industry like WPP suffering potentially from various things, it seems like a good go-to phrase, doesn't it? But the jury is very much out on whether they will profit from that. And yes, Openreach, as we wrote about recently, clearly that's the big hope for BT, is that all this CapEx spend on full fibre broadband will bring in higher revenues, higher margins. The uncertainty is over how many customers it will lose to altnets and what have you, which is why some of the parts valuations just for Openreach are so disparate right now, because people very much disagree on that. But anyway, that's a separate feature. Let's finish by looking at acquisitions, because we've spoken about hive-offs and spin-offs and things like that, companies focusing on most profitable parts. Clearly the rationale, or the stated rationale behind pretty much any acquisition, is this will be good for the company. But through this lens, what kind of things should we be looking for when a company makes an acquisition?
Well, I mean, everyone's looking for something that's going to be earnings accretive, but also you probably want to be looking at what are going to be the longer run. As you say, you mentioned the word synergies, favorite of management speak. But actually,
Yeah,
what's the outlook for organic growth? You still want to keep an eye on the underlying trend for other divisions as well, because you're looking at that it can, obviously bolt-ons are good, but sometimes they can again be sort of a shortcut to sort of to hide other longer term deficiencies. So again, it's important to sort of to think about what our competencies are, what's the outlook for those as well, and also I think the really important thing is how does it alter a company's capital structure and the quality of its overall earnings are going to be reported. How are you taking on debt, for example, in order to increase maybe accounting profit, but is it going to take longer? Is that going to decrease cash conversion, which ultimately is what throws off the capital, gets reinvested into the business or distributed to you as a shareholder? And on that note, as a shareholder, if it's a cash for shares acquisition, are you diluted to any great extent?
Indeed. Well, there's a lot more detail on that in the piece. And on all these things we've discussed, it is available in the magazine this week and online, so do look out for that. To finish today, though, we're going to look at weight loss drugs. Two very high-profile companies, Novo Nordisk, Eli Lilly, and Novo Nordisk in particular has had a really terrible time of it this year. Various setbacks, which we'll get to in a minute, Julian. And now, as of the last couple of weeks, Eli Lilly has joined it in the setback group, owing to some disappointing drug trial results. Can you give us a bit more flesh on the bones there? What's gone wrong? No pun intended. What's gone wrong for these companies in recent months, Julian?
Well, it's a debate whether it's the companies that are doing particularly wrong or whether investors are completely mispricing the prospects for the obesity products more generally. But essentially what has happened is that Eli Lilly had its worst day in a quarter century last week because its oral pill version of its Zepbound Mounjaro product, which is an injectable product, didn't do quite as well as they thought in terms of the amount of weight loss it's going to generate when compared with the injectable equivalent. So I think it came in at the bottom of the range, like, you lose 13% of your body mass on a pill versus 20 to 25% if you're on an injectable. And the market deemed this enough of a failure to wipe 15% off the share price in a day. So it was a pretty spectacular crash, really. But from very elevated heights. I mean, Eli Lilly at one point was something like 200 PE or 43 PE if you look at it in the next 12 months type of valuation. And you can pick up a decent pharma company in the US or the UK for about 15 at the moment. So it's the valuations are very heightened, and clearly, if they're not perfect in terms of the results that come out, then the investors are punishing them very, very quickly. So that was Eli Lilly's problem last week, and ironically, that led to the market buying up Novo Nordisk shares in preference, because if Eli is struggling with its pill, then that gives Novo Nordisk a kind of a little bit of headroom with its own pill products. And the mood has been very seesaw, very going from one extreme to the other, generally speaking, with these companies. And Novo at one point at the start of August had declined 30% in a week, one of the biggest share price declines for a major company in many years in such a short space of time. And that was all around the kind of chaos within its management structure. So they got rid of the former CEO, Frederick Jurgensen, and he's being replaced by an insider called Mazar Dudsta, who joined as an office boy and has worked his way up to CEO, which isn't a bad progression, I suppose. But there is a sense that this seesaw sentiment, it makes it very hard to actually value what's going on. So, but secondly, it is creating lots and lots of price inefficiency. So clearly, people are taking advantage of that with short positions, or it's all being exacerbated, I think. And these are two classic kind of meme stocks where people will trade very quickly over the phone.
It's interesting, isn't it? Because Novo, as you say, it's replaced the chief exec. It's had the latest, or it had a profit warning at the end of July, partly due to this pirated alternatives available in the US, which the regulators tried to ban, but still seem to be eating into its sales very much in the US. That has been a concern for a while. However, as you mentioned, there was a little bit of a rise on the Eli Lilly news, and it may be the case that Novo is in a decent position when it comes to its own attempt to develop a pill. Clearly, the pill is seen as really the next phase of this massive weight loss drug boom, obviously because it's far more easy to consume than and to take regularly than an injectable, which is also why people are prepared to accept some degree of less efficacy, shall we say. It's still pretty effective. It's not as effective as an injectable, but people will still prefer to take a pill if they can.
The problem
The
problem is that it's not a mature market, so they're not. People don't really know yet how it's going to progress. We're in a very early stage of anti-obesity drugs, but the pill is going to be quite good for people who want to maintain their progress, because the problem that a lot of people face when they come off of the injectable is that they pile all of the weight back on very, very quickly. So you either have to taper it very carefully, or you make massive lifestyle changes just as you're about to come off to make sure that you don't just put it all on automatically. So there is a market there for a pill that's not quite as potent, should we say? But the reason why people are looking again at Novo is that what was clear from the results, even though they did cut the forecast for revenue growth this year by about 5 percentage points, so it was quite a big cut in the forecast. But when you looked into the guts of the results, what became obvious is that they are actually planning better to roll out a pill, certainly far better than they did with Wegovy when that first came on the market in 2022-23. That the reason why a lot of the management at Novo were fired is that they rushed that ramp up in the first instance with the injectable, and that led to all sorts of manufacturing problems, delays in delivery. Arguably they lost quite a large percentage of sales by not being properly ready. And in these results, it's clear that they've been spending a lot of money on manufacturing facilities, ramping up things up properly, and they've managed to get actually quite big Eurobonds away in order to finance it. So they got a 6 billion Eurobond away quite successfully, and they used the profit from that to add to their manufacturing capacity. So it looks a better organized. They look to be in a better organized position, which didn't go unnoticed, I think, by the market. And if they can get a lead on, then suddenly their position changes very, very quickly from the point where the market effectively is saying, well, your weight loss drug is now worthless if we've given up all the gains that you've accrued on the stock market since 2023. In 2023 it was valued at 50 times earnings, and now you can pick it up at 13, 14 as an average. So I mean, it does illustrate this kind of wild swings problem that investors have at the moment with this segment of the market. But also, arguably, the fact that they've been doing the groundwork in a much more systematic way I think at least points towards a slightly more successful rollout for their second line pill treatments. And if Eli are delayed, that also gives them a bigger head start.
Yes, absolutely. I mean, there's no doubt it wasn't just the pirated options in the US causing the problem. It was very much the perception that Eli Lilly's injectables were superior to. So if Novo can take the lead on the pill side of things, then that can really bring things back. I mean, we should consider, I suppose, the possibility that someone else comes in with a pill. I mean, I think of Terry Smith, who always likes to say regarding Nvidia, it's not always the initial trailblazer who ends up being the big winner. Ironically, he didn't own Nvidia for that reason, but he does own Novo Nordisk, and maybe they're at risk of that happening.
There is a lot of research showing that being first to market in pharmaceuticals doesn't really matter that much. The problem you have, if you want to use an analogy, is that if you sit down to lunch first, other people will come along and steal your lunch eventually, and people have gone. Healthcare economists have gone back over many years and found that actually being fifth to the market in relative terms is no worse than being first or second in the profitability that you ultimately generate. And obviously, if you're first in, you've done all the hard work. So people are kind of come in and say, well, okay, we've got this safety profile, this efficacy profile that we can base our own launch on, and we don't need to be quite as we don't have to do quite as many hard yards to get it to the market. So there, it's part of their strategic mistake, I think, to start with, was to think that rushing in would make a huge difference. And I think the investors have also made a mistake in backing that.
Yeah, indeed. What about the next steps for each of these two companies then? Novo, clearly the new chief executive, Eli Lilly trying to bounce back from this big sell-off. What's the next things we should be looking out for?
So Novo's, at this point, they're waiting on data, certainly from the next round of pills, and whether they can get anything out of CagriSema, which was supposedly the injectable follow-up from Wegovy. So yes, they'll be seeing if there's any new data they can get there. He also needs to restructure some of his management team. There's been a lot of musical chairs at Novo at the moment because of many senior managers having been moved on. So the next results, where he's fully in charge, we'll probably get a better idea of how they're going to approach it, how the track record of the people they appoint to looks to the market. And Eli Lilly, I mean, they are still in a very strong position. I think there's no question that it's a much broader base of a company. So it has areas other than the obesity products in which it generates vast quantities of its earnings. I don't think the problems for them are quite as dramatic as the fall in the share price suggests. They will probably bounce back with an improved pill offering. If it's not first to market, it's probably not the worst situation for them. But they're still priced richly. I mean, 43 times earnings at the moment. When you can pick up a US company at between 13 and 16, seems to be about the range. There's still a lot that could be given up, a lot of value that could be given up if they get more stuff wrong. Yes, but it gets back to this. Nobody really knows how to value these products yet.
They are still priced to a degree for perfection, aren't they? Maybe a little bit less than a week ago, but as with many US companies, they are right up there. Anyway, that brings us to the end of the show. We have run out of time for today, so thank you very much, Julian, to you. Thank you, James. Thank you, Hugh. Thank you to our producers, Vic Thornton and Maddie Apthorpe. We'll be back next week with another Companies and Markets show.